Good morning. This is another installment of the video series Romeo CRT 2023 review. Today we're going to be reviewing the 15th trade in the 2023 PDF, which was a higher time frame DXY long. That is a really impressive trade. It took, as you can see here, in April. It hadn't even reached the sell side liquidity yet, and there was a prediction made, basically annotation on the charts, to be looking for a rebound off of the key level, and it did that in April, and then it has an interesting pause period, which I can talk about and go into. And then on May 3rd, Romeo tweeted, DXY is just warming up. And that is pretty much the exact entry point for the peak manipulation into the distribution, because after that, after May 3rd, you have what is essentially a weekly time frame model distribution in DXY. So you are the beneficiary of a move which follows the linear regression trend line pretty closely, and we can talk about like the little wrinkles in there as basically buying opportunities for a longer time frame trader, like a longer term swing trader. And the move goes from just under 101 in the dollar index, which is like 100 spot 80 ish, to just under 105. So it goes all the way up to 104 spot 22 at the moment of this after image. This is a quote unquote failed CRT because it doesn't quite get to the top of the range, and we can explore why price didn't get all the way to the top of the range. And if you look, so this is the daily chart, there's a huge daily order block that sticks up. So this large up close candle that immediately precedes a down close candle, and then it is immediately preceded by a bearish FVG, a few actually consecutive bearish FVGs. This is actually the root cause of the this internal liquidity sweep. These daily candle consecutive FVGs, you could say, well, what was the motivation behind bringing the dollar higher? Then you could say, well, this was the cause, because immediately after this there was a reversal. All right, I'm going to go to FX replay now. Good, you can see it. All right, so let's launch this chart. Let's break this down really quick. Okay, and I have to go to the DXY, and I'm going to switch my. So for some reason, it's been jumping to the other view. I don't think I had the layout quite selected. This is actually my second attempt trying to record this video, so there's some annotations on the chart already. So this is this is actually 2-day. We'll go to the daily time frame. So yeah, so we have basically, just to go right from the beginning of this, it's a 2023 bullish model, which essentially is like it trades. So in early February, the dollar, it almost touched 100 even. It went to like 100 spot, 100 spot. Let's look at the daily low there. 803, 100 spot 803, and then it violently retraces back higher. And so I would call this like the initial aggressive move in a Romeo A to Z model. So for long-term followers of Romeo, his very first video session that he made available to students was this A to Z, and that's essentially like saying that's the same as a turtle soup. So it's a bullish turtle soup in this case, because we have a violent initial retracement, and you could be trading this, right? Because there's probably internally some good reversal signals, or you could essentially treat this as a pause CRT, opportunity. So I would say that this entire well, it's actually not quite a pause CRT, because you do have some good symmetry. So let's look at the 3-month chart here. Actually, no, let's look at the 1 month. Yeah, so it's the 1 month that shows this. It's not really a pause CRT. It's actually just a 1 month 3 candle CRT, bearish. Initially. Okay, so this right here is candle number 1, February, when you had that initial aggressive move off those lows within a monthly fair value gap. Then candle number 2 on the monthly 3 candle CRT is March, and I wouldn't call this like a pause CRT, but it definitely goes a lot slower, right? Because it takes all of March to grind lower back to from the highs at 105.85, right? So quite a large range, all the way back down to the close of that candle at 102.60. And then you have April's candle, and April's candle, it essentially continues the slower pace. It's slower than in February when it was going up. It's the slower pace downwards to complete the 1 month 3 candle CRT and to hit the final target. So if every exit is an entry, right, then what we do is we can resolve this to a turtle soup model, a bullish turtle soup model. We can look out for, once the final target's hit, that particular week formed a large wick below the candle, below the weekly candle, which is very bullish. So it's essentially that classic market profiling where you have like wick below key level, bullish. And then you start to study price for signs of reversal, and if you're me, then you start to count candles and start to look on the correct time frame. Now, I believe the weekly time frame is the one that fits my particular approach to this, because I always look for between 7 and 12 candles to frame a turtle soup. So I look for the origination candle, and the origination candle is essentially like it either contains the key level or it is the origination of the initial move, which is then to be turtle souped, right? So it's either the high or lower the candle contains the key level, or it's the candle itself contains the key level, or the high or low of the candle denotes the key level, and it's the reason why the move started. So this candle right here, the last week of January, kicks off this initial aggressive move higher. We can start counting from here. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. So this is really pushing it in terms of the length of what I would consider like an appropriate model. If I get past 11, I have to jump up to a higher time frame and look for the move higher to happen on a higher or lower, like the distribution phase, to happen on a higher time frame. You can think of all this as accumulation, right? All of this whole thing, all 11 candles is accumulation. And then you have the last candle. It should be peak manipulation. Now, this, in this case, rather than having peak manipulation into immediate distribution, there's a little quirk here on the higher time frames. So often with these models on the higher time frames, you get a little bit of noise sometimes, and you get these wrinkles where it doesn't quite fit how it should look on a 4-hour time frame or a 1-hour time frame or a 2-hour time frame. If you're looking all the way up at 1 week, 2 weeks, 1 month, a quarter, then sometimes there's timing issues. So I'll show you. The first quarter of 2023 started in January, and it was the first quarter that contained this aggressive move higher. And then Q2 starts in April. And in fact, market makers have placed the peak manipulation candle. In other words, this is the candle that after this candle, you're expecting 3 weeks of a very strong move of a retracement back into this range. But instead what you get, and I'll use the language that Romeo used, a warm-up period. A warm-up period. So in other words, rather than price immediately ripping higher, so like a large bullish candle here in the 3rd week of April, another large bullish candle for the 4th week, and then a 3rd large bullish candle for May, extending all the way up pretty much to the top of the range, right? That would be like the traditional distribution payoff, or, you know, if this is the setup, right, then this is the payoff you'd expect. We've floundered. Price has essentially created an inside bar. It created another inside bar relative to this one candle here, this peak manipulation candle, and then it creates a 3rd inside bar. So something else is going on here, and my short explanation for it is it's about the quarterly cycle. So we need to get to a quarterly swing point in time. And quarterly swing points are kind of this older ICT concept, but basically it involves visualizing a quarterly candle as from the open. So the open of Q2 was on April 1st, 2023. From the open, it doesn't immediately go into distribution. It needs to accumulate, and then it needs to reach its own peak manipulation, and then it needs to distribute. If there are 13 weekly candles in a quarter, then you would expect the peak manipulation to occur around candle 3, 4, 5, 6, somewhere beyond the candle open. So in this situation, you're expecting it perhaps in the 1st week of May. And so Romeo was watching out for that. And when price retraces into this, it's essentially internal sell side liquidity. It is fresh liquidity in terms of, like, if you look at, like, you're going past the lows of the previous week. So you're saying, basically, if that's the close of that weekly candle there, I think I started it right on the formation of a new weekly candle. Let's see. I haven't yet. But let's get us into May. Okay, so I'm sorry. So that is so actually disregard that, because this is actually the weekly candle that we essentially shift our analytical framework to be long. The timing is really interesting. So first, we're going to look at lower time frame. For 1 week, the signal time frame is 4 hours. That's like the classic Romeo time frame pairings. I've already denoted this order block. It's a really strange order block because it doesn't actually involve the body of a candle. It's a wick. So the lower wick here becomes a classic Romeo order block. Well, not quite classic because it is a wick. You can select a wick for your order block if the wick dominates the candle. So price wants to retrace into the consequent encroachment of the wick, or even fill the wick in as we find our low on the 4-hour time frame. And the rule for validation and invalidation, you can basically say if there's two downward closes below this, then you might be looking at yet another PD array to deliver off of. But we test the extreme low there. You should look for SMT with EU at that point. I'll switch over to EU. I hope you're not jarred by it. Let's see if it was within that daily candle of 4 hours. Yeah, so EU does not make a higher high. So there's no SMT between EU and DXY. It's just something extra if you notice it. So this is itself a turtle soup model. Right, so you have a pause CRT higher, well, more like a symmetrical CRT higher, with a really rapid distribution, and then you get an entry here. So if you're trading in the New York session, I'm sorry, if you're trading in the London session, the early London session on Thursday, May 4th, you would have had longs. Longs on the dollar just means pick your weakest FX cross, FX pair, and short it. And you, as a shorter time frame trader, if you are one, you should be doing that. So I noticed that little gap junction there that happened in Asia session, and they really want to fill that in. So they rip higher, then they rip lower, then higher. It forms an order block. Speaking of order blocks, there's a nice FVG. Oh, I spoke too soon. So this week is like very much another manipulation candle week. Like, you don't really get an explosive move higher. And in fact, price is so fractal, right? So this model worked just like the higher time frame version of it, where it just pauses. And so when I said work, I should probably say did not work. Though within the first 3 candles, you do get a pretty good retracement back into the highs. I guess not. Oh yeah, because it's the time frame. So yeah. So within the first 3 candles, I'll resolve this on like a more normal time frame. It's probably the 8-hour model. 12. It's 12. Yeah. So you have, if that's your peak manipulation candle of this turtle soup, within the first 3 candles, it's actually on the 3rd candle, so it's very lackadaisical. It stabs into the equilibrium of the range, so you do get your 50%. It is a quote-unquote failed CRT, but you do get your partials. So that completes. And then there's a little bit of like kind of time frame compression where you get yet another little model to get long. From a technical standpoint, actually more like a mechanical standpoint, in markets, oftentimes they'll use barrier options on specific levels. A barrier option essentially like starts to kick in as price stabs past a certain level. You start to like essentially like be able to exercise these options and like, buy dollars, buy Dixie to push price higher. And that's what often creates these levels that are very flat. Like, that's what creates the, with price retesting and then retesting again, and then they kind of ratchet things up, and it looks like 101 even is a level that they're specifically guarding. And here we finally have, on May 8th, we finally have some productivity happening. So you had that 8-hour or sorry, a 12-hour turtle soup, and then it kind of like fails. And then this smaller one, and the smaller one kind of works like a butterfly CRT, where the move off of those lows become a much more substantial move. And we did retrace lower, so we have yet another model, a lower time frame model. It's actually really natural in the DXY. The DXY is 60% weighted to the euro, and the euro is extremely choppy. Anybody who's traded the euro USD for quite a long time knows how choppy and rangy and involuted the price action can be. Yeah, so this is actually, if you considered, it's just like, it's very fractal. It's very fractal. So in other words, if we get our 2023 model with a cool down or perhaps a warm-up period on the lower time frame, like perhaps maybe on the daily time frame, we have the same 2023 model with a cool down, and then we have a rip higher. At this point, we're within our distribution, and ideally, when you're looking for these distributions, this is your second target, right? The top of the range. But if I go back to the daily chart, again, there's this fat up close candle, this daily order block that works like a really good level for price to bounce off of. And it just happens to be located around the 618 retracement. So price is going to tap into equilibrium and balance this range. And then once we head into this order block, there's going to be a chance to have a reversal, essentially like in early June. So if you want to think about it in CRT terms, this is a bullish CRT eclipsing the range of the two down close candles. And then it only, so actually more appropriately, let's go back to the monthly chart here. Because I actually think because the 2023 model doesn't quite work in this case, it's probably better to just frame this as a CRT. Just because of the timing issue with the 2023 model here. So you have like price moving higher, but it's on the CRT time frame, basically saying that like this month of May becomes a 2-candle CRT to shoot past the April down close candle, and then it shoots all the way up to the 618 of this entire range. So it's essentially saying, I'm going to give you a 2-candle CRT of this teeny tiny candle, this little monthly candle, but it's a failure swing. Like as we get into this internal liquidity here and exhaust that, that's going to give us another entry to be lower. So on 1 month, you can look on the 1 day for an entry for the CRT. And we do have a 1 day model number one, the newer model number one. In other words, if this candle right here is a you could put it as many different ways as you wanted, but essentially we have a close above the high that broke the low, and then we dig back into that candle, and then it just takes a number of days to fully accumulate, and then we get another little manipulation. So here there's another model number one, as we let's call it that candle, we I guess it's in progress. But there definitely are, the thing I worry least about is these signals, these lower time frame signals. I'm more interested in getting the analysis correct, as far as properly framing 2023 turtle soups that are predictive in nature, that play out the way that they should. So here's the progression of our monthly candle CRT higher. So I've outlined the range of this daily body. I've outlined the body of the daily up close candle, this potential bearish order block that we're going to stab into. I think we actually end up like closing above. We kind of do like a turtle body soup, if you're familiar with that framework that was popularized. But then it's this BPR that I would really look for. It's nice. It's a bullish fair value gap immediately followed by a bearish fair value gap. So a really nice BPR there. That's where you could start looking on the lower time frames for definitely like scalps to hit a model number 1 off of that final retracement. So the May monthly candle is coming to a close at this point. You do get a nice breaker entry right there off of that breaker. So if you missed your model number 1 down here, you can get a breaker. You might even get an FVG entry. Yeah, you do. So you get an FVG entry from a repurposed IFVG on the other side of the range if you wanted. So that's another opportunity to get long into the equilibrium. You could treat your equilibrium level as kind of like you could treat that order block as like yet another target and do essentially what's like a kiss of death trade off of the opposing range FVG. I mean, you're on the higher time frames. Every single one of these candles is an entire day's worth of trade, right? Yeah, so here we are in this order block now, and now we can start looking for reversals. And it's at this point when I would probably consider, if I was handling this as a, well, we can frame it in 2 ways. There's two analytical frameworks to frame it with. If I was kind of stubborn and I was basically saying, well, even though the actual like taking out sell side liquidity happened all the way back in mid-April, if I characterize that first week of May, including that Romeo tweet, May 3rd, as still the setup, I'm gonna grab my date tool and we'll look at how many days the setup was. So I'm kind of being generous, or I'm being a little bit more flexible here with our, and so let's say that the peak manipulation is here. And so that's 67 bars. So essentially you're looking for 21 trading days of distribution. So we're about to time out. And this is what I do. So when I'm trading this on the lower time frames, I often have a time-based exit. So I obviously look at the chart because I'm looking for a PD array that will get me out of my trade. Like, for example, the PD array that gets you out of this long analytical framework long here is this daily order block, and just kind of realizing that this daily order block is really going to stall us out, isn't it? I'm going to go to the higher, a little faster here. So there's a characteristic, yeah, so right there, you get a turtle soup, essentially. And so that down close candle out of the daily order block range should really be worrying you. And then we slice back up into that BPR. We probably even turtle soup. No, we don't. Do we? Let's see. Yeah. So now the trade is essentially timed out, and I'll be tapping my watch if I was long, and then I would look at this and I'd say, well, this is a bearish turtle soup. And this is itself a 2023 model to get short. So in other words, here, I'll delete all this. After one model times out and you get a exit signal, which is essentially a reversal, your exit signal becomes an entrance signal. And so this is actually on the weekly time frame as well. here's the origination candle, the candle that contained the daily order block. And so there's some internal level, like the open of that, I'm sorry, we're not on the daily, we're on the weekly. The open of that week, opens of higher time frame candles are often used as, arrays. They often contain arrays, like the new week opening gap. Okay, so price tapped into the new week opening gap. This is the origination candle now. The lower time frame hallmark was that large daily order block, right? And you can start candle counting. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. 12 is actually the length of the model. So let me do that one more time. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Yeah. So it's actually a little long. So I would even characterize this as a 2-week model now. 1, 2, 3, 4, 5, 6. Oh man. So we'll call it 12 week. Yeah. So it's perfectly 12 weeks. It's like, actually, you know what? Let's go back to that 2-week model. This could be the origination candle on the 2-week model, right? Just to give us, yeah. So, and then we could say, well, maybe rather than the close, you could say, well, maybe rather than the open of that candle, what we really did was, since we kind of wicked past it, it's the close of that candle. The close of that candle was targeted. And if you're looking for like that super high precision entry, that's exactly the level to use on the DXY here, the dollar index. So we wick into that, and then you're expecting 6 weeks of distribution lower. And let's see what we get here. So these relative equal lows become our downside target. We probably get it within 2 2-week candles. The reason why I'm thinking we get it within 2 2-week candles is, okay, so here we go. You know what? On the weekly chart, let's look at this really quick. Well, you know what? Let's just let it play out. Because I think we just had another failed weekly time frame. Okay, yeah, we do. So this is the advantage of like properly characterizing. To get on the higher time frame gives you the patience to hold. So in other words, if I had stuck with it with a 12 candle model, which I think I should say 7 to 11 candles, because I really don't like to trade the 12. We time out. So the first 3 weeks of distribution times us out. And then we get this little involution, a smaller wrinkle. But if you just had zoomed out a little bit, we have our initial 2-week period of distribution, and then we just get a pause in the middle, and that's okay to have the pause in the middle because you have another 2 weeks to go. So in other words, if this is 7 candles of setup, you're expecting 3 candles of payoff, right? And it's the third candle that we really get this violent aggressive move after this turtle soup right there, or CRT high. So in other words, that's a CRT entry right there, a 2-candle CRT on the 2-week time frame. So yeah, Romeo called this out, really impressive, and then in every exit's an entry, so we get another bearish entry to continue. The dollar really lost a lot of ground here in the first half, or actually, we could call it the first 7 months of the year. Alrighty, well, thank you so much.